Hi, everyone. Welcome to the DPI Pod, where we talk to the top pre-seed GPs to deconstruct pre-seed investing. I'm your co-host, Brendan Schmidt, a principal at Sierra Ventures.
Hey everyone, it's Vignesh and partner at Sierra Ventures. And for our listeners, Sierra Ventures is an early stage focused fund. We invest in B2B AI and frontier tech. And thank you everyone for listening. Today we have Gaurav Jain, who co-founded Afore Capital, the world's largest dedicated pre-seed fund. And he spent the last decade proving that the best time to back a founder is before others think they're ready. And so super excited to have Gaurav on the show today. Gaurav, thanks for joining us. And maybe just to start, love to hear your story. How did you go from, maybe to spoil it, rim to Afore?
Thank you, first of all, for having me. Though it sounds like my better half, my co-founder, has already been on one of your events, so I'm glad I finally have made the cut as well. But thank you for having me. My name is Gaurav Jain. I'm one of the founders of Afore Capital. I grew up in India. When I was 15, my family decided to move to Canada, to Toronto, finished high school, went to University of Waterloo for software engineering. Started my career at Research in Motion, now called BlackBerry, back when it was still a cool company. Back in 2004, I was an intern there, shipping code while I was still a teenager, which was a dream come true. From there, went to Amazon as an intern as well, worked at a bunch of different places, and then coming close to graduation, decided to start a company. I started a company in the mobile space, I guess back when that was the hot new thing, circa 2007, 2008. That company became venture-backed. That was my first exposure to venture capital as a founder myself, being on the other side. I was always very intrigued by what VCs do, but at the time was very heads down building my company. That brought me to the Android team at Google, and when Google was going all in on Android and mobile to counter the threat coming from Apple and iPhone. And I was part of the team with the mandate to help grow market share for Android. We went from less than 1 million total users on Android when I joined to about 1 million new users a day by the time I left. Of course, today, 3 billion plus people use it every day. It's one of the most popular pieces of software on the planet. Then switched gears, first went to business school and then joined a fund called Founder Collective, kind of as Gen 1, if you may, of micro VC funds, started in like 2009 timeframe. I was the first person to join the team after the two founders. Was in it for 4.5 years, had a brilliant time, got a chance to invest in companies like Airtable, started by my colleague from the Android team. He went off to start Airtable. I joined Ventures, so we had a chance to invest. Cruise automation, a whole bunch of other things, and then spun out in 2016 to start Afore to focus on pre-seed, which is, it's amazing we're on a podcast today with pre-seed in its name, and how far the category has come in 10 years. So it's honestly, if you had asked me, this would be a reality 10 years later, I wouldn't have believed you, but here we are. So I'm excited to talk about all things pre-seed.
Thanks, Gaurav. So I think there's like this famous story, like you and Anamitra met in 2012 at one of the Foundation Capital dinners. You're both PMs, and walk us through the history of the industry, because you even said like 10 years ago, I would never think pre-seed would be a thing. You guys sort of coined the term, and what were the dynamics leading up to that before you guys got together in 2016 and officially launched?
Yeah. In some ways, it's really the story of like a lot of companies we invest in, which is things start off with like an idea, it's just like sort of a hypothesis more than anything else. And one thing leads to another, and then eventually becomes a category. I think that's sort of been the history of pre-seed. Where it started was, I used to be a seed fund, and I would very often find myself telling founders, I like your background, I like your idea, but you're too early for a seed round. Go raise a little bit of capital, get the product in market, get some traction, and then we can underwrite a $3 to $5 million round. And the founders would turn around and be like, so let me get this straight. So I need money to get traction, but I need traction to get the money. Like, how the F do I solve this catch-22? I thought that was your job. That's what people told me VCs are supposed to do. Honestly, all I could say was touche. Like, I don't know, like AngelList, angels, maybe some incubators, whatever, like figured it out. Honestly, didn't have a good answer. And when that happened increasingly, and, Anamitra and I, as you mentioned, we met actually before we were both at our venture funds, when I was a student scout for Foundation Capital and he was an EIR, and he eventually joined as an investing partner at Foundation Capital, and I joined Founder Collective. We did a bunch of deals together, but really got to know each other and would compare notes, and he was seeing something similar. And basically our hypothesis was that, look, I think there's an opportunity to kind of point this cannon that we have a stage earlier. right? Where we feel like there's a phenomenon here where founders are being underserved, which, at a high level, you think about it, there's so many venture dollars that go in, you're like, how can they possibly be underserved? And it's true. Like if you look at it from a macro perspective, when you double click and you look at that inception stage, and again, keep in mind, these are usually first-time founders, right? Or at least not celebrities. They haven't made a lot of money for somebody yet. The ideas are very rough. They don't have any traction. Product's not in the market. I can see why it's hard to raise that first true institutional capital. But we saw that as like an opportunity. Honestly, didn't know what to call it. It was starting to be called pre-seed, but it was a negative term, believe it or not. It was reserved for founders who couldn't raise a seed round and were forced to call it pre-seed. And part of it is pre-seed, the way it was practiced at the time, was like a 250, 500K round. It was sort of like this sheepish, like poor cousin of like seed. It's like, oh, couldn't raise seed, so raising a small pre-seed with the idea that I'll raise seed in a few months, right? And we said, it's just not the best product for founders. So what if we institutionalize pre-seed in the way seed has become, first-class citizen, and we're going to blow up this category. We started this pre-seed summit where we had founders of companies like Instacart, Pinterest, DoorDash, all these amazing Cloudflare, Stitch Fix, Affirm, PayPal come in and talk about their pre-seed journey, which again wasn't called pre-seed back then, but we really wanted to make the 0 to 1 stage synonymous with pre-seed. And like when Tony Zhu from DoorDash came in, he talked about not DoorDash, but Palo Alto Delivery.com. Right? That's where the company started. Right? They had a hypothesis that like food delivery in places like Palo Alto, it's like underserved and we should fix it. They weren't thinking $100 billion DoorDash. They were just thinking of a hypothesis. And when they proved that right, it kind of expanded the market from there. And I think for us, the pre-seed journey has been very similar, which is why I think it would have been hard to predict, frankly, where we are today.
I mean, it's interesting, and we're obviously, in this AI world, we'll come back to talking about some of this AI stuff, but before we can back the next great AI company, you had to convince your LPs first that pre-seed was a category that was investable. Maybe talk us through that first fund. Like, how did you convince LPs that this category wasn't like adverse selection, right? It's like you're not getting the leftovers of the seed funds that didn't want to do the deal, and that there was value that was missing. And love to hear any interesting stories from that first fundraising journey.
Yeah, look, obviously raising a first-time fund is hard, period, regardless of whether you're trying to create a new category or not. But here's why it was hard in retrospect, and I can sort of see the diligence process that LPs went through, right? So we go in, we talk about our pitch of like, we think pre-seed is where founders are being underserved, we think it's going to be a new category, blah, 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 and that's what we're going to focus on. LPs are like, cool. What do they do? First thing they're going to do, right? And I understand, like, it's a normal reaction. The first thing to do is they call their seed managers. And they're like, hey, we heard this pitch, this thing called pre-seed. Is this real? Like, what do you think? And of course, seed funds are not going to be like, oh yeah, there's this thing called pre-seed that we don't really do. Like, we wait to see which ones are taking off. And then I know you gave us money to be the first investor in these companies, but we really don't like being seed first investors. We like being second investors. Like, of course, you're not going to hear that from your GPs. So the LPs are like, oh, okay, well, this sounds like a fad. It sounds like a stupid idea because, my seed managers who made me a lot of money think this is stupid. So cool, you put the phone down, right? And that's it. Thanks, but no thanks to us. Now, that being said, there were LPs who did the second level of work, right? Who went beyond that and called founders as well. Not just their GPs, but founders, and said, hey, we heard like when companies are getting started and if you're like a first-time founder, like it's kind of hard to raise money and seed funds tell you that they're like, you're too early for them. Is that true? Guess what the founder said? Yeah, hell yeah, it's true, right? Like, I tried to raise a seed round. This is what all the great seed managers told me, and like I didn't know what to do, so I bootstrapped it. I went to this incubator, this accelerator, scraped a bunch of capital, and then once I had some traction, then of course, like I had world was my oyster, and I think those LPs got it. Right? Those LPs were like, okay, despite the fact that pre-seed is a negative term today, despite the fact that my seed funds are telling me that pre-seed is a gimmick, I think because of founders, ultimately, all of us here, we are in service of founders. Like, that is what matters. What matters is what founders, the product we sell is to founders. And I think the LPs that understood, like, founders, the ultimate customer is being underserved, whether you want to call it pre-seed or seed, whatever, doesn't matter. And I think if somebody can serve them better, that should be a thing. I think those LPs, got there, but it's hard, man. It's hard to convince people to do the second level of work. And look, we do diligence for a living, and it's sometimes hard to do that second level of work because you've got just so much flow coming at you, and you're constantly trying to triage. So again, no judgment, no harm, no foul, but I'm thankful to the LPs that believed in us and got us into business.
Gaurav, along with the fundraising, you both are thinking about what are the founding principles going to be of the firm. Obviously, pre-seed is like baked into that. That's your identity and has continued to be your identity. You're both product guys. Like, I think it's super cool how many different programs you have to support, founders, whether pre-investment, post-investment, finding sourcing is like, I would say, like a very, very important principle. I know Anna Mitra's talked about it before, but what went into the founding principles? What are some of the things you talked about? And, obviously over the last 10 years, how has that come to fruition and really paved the way for success with the firm?
Yeah, we really take a page from our founders' book. That are constantly running experiments, iterating, and I'm sure you guys feel the same. When we look at our more successful companies, they look so different than anybody could have predicted. Including the founders themselves, and I think it's because they just kept learning from like all these experiments and let the customers kind of lead the dance and let the market lead the dance as opposed to being too top down. And I think similarly, as you pointed out, we run a lot of experiments. We're constantly launching stuff, mostly kind of sourcing experiments, and because we really believe venture is a series of temporary advantages, and in some ways, honestly, like pre-seed, we think was a temporary advantage, right? And I think there's obviously many funds practicing pre-seed today, and in fact, even Sequoia, when they announced their most recent fund, they said, I guess we're a pre-seed fund now too, and I think when we read that, we're like, all right, guys, time to like figure out what's next, but like, I think you just have to keep running experiments, just like we expect our founders to, and some work, some don't work. And I think, we've started off with one product, which was pre-seed, which was this idea that, you're looking to raise $1 to $2 million to get started. We can lead the round. That was our innovation, is we can lead the round and price the round. Because what we would hear from founders very often was like, I'm trying to raise $1 million. I have $5 million of follow-on capital lined up, but nobody willing to step up and lead the round, right? So that was a problem we solved. And that product worked great for the first few years. But then increasingly we found that there was like 6 to 12 months before, the founders are ready for a proper pre-seed round, that we didn't have a product for that part of the journey. So we ran a bunch of different experiments. Some worked, some didn't work. And then eventually led to what became Founder in Residence, which is this idea that, hey, the team is really strong. The idea needs a little bit of polish. Why don't we have them come work out of our offices, and we'll kind of put them in front of customers and run through iterations. And maybe they'll pivot the idea completely. Maybe they'll pivot it a little bit. That's fine. And we will support them through that journey and get them ready for like a proper round, right? And then we launched a third product for college students as well. We called it FIRU, where now increasingly we're seeing that, kids that go to college, they kind of first year in, they're like, oh my God, this is so boring what I'm learning in school, and I can't deal with 4 more years of this. While what I'm hacking on the side and building on the side is starting to take off. Like, now I have a fork in the road. Do I stay here for 4 more years and possibly not get a job at the end of it? Or do I go believe in myself and like go do something for a few months at least, see if it works? If not, then I can always come back to school. So we built a product around that, right? And said, hey, if you're one of those students that's looking to for a home and some capital, we can provide that. Again, have folks come out of the office, provide a bunch of mentors for them. So we're constantly running these experiments, and frankly, in 2 or 3, 5 years, maybe the products will have be completely different. I just don't know. But we ultimately kind of work from first principles, as we're here to serve founders. We're here to like provide the best product for them to get them to product market fit. That is the North Star, is getting to product market fit, and how do we increase our odds in the maximum way possible to get them there. And that's it. And that's why we've chosen not to be a multi-stage fund. We've chosen not to lead seed or Series A rounds, like, because we believe what we do is like hard enough, and there's enough surface area for us to cover. And within that, we're going to keep experimenting and keep launching new stuff.
Gaurav, who runs the angry parent line with the Founder in Resident University?
Oh man, what's interesting is you realize that these founders, it's not just that they're a few years younger; they're just in a completely different phase of life too. So we had to create some rules around the office because we share this office space with another company, and we found some days we would come in the morning and the janitors would complain that people were sleeping in the office the night before, and we have like shower downstairs too, so it was like a full stack place, and we had to and part of us was like, I get it. Like, it's really good that people are like working, all night, pulling all-nighters and coding. Part of us like, this is still an office and not an Airbnb. So we had to set some rules of house rules, and there's like a lot of stuff like that comes up when you're dealing with a very different demographic than your previous job. Which, look, I mean, I go back to college, it kind of makes sense. Like, we're just in a different mindset, and especially when you haven't had any real work experience, and it's just the way they think, operate is just different. So all of us have had to figure out how to make this whole product work.
But it's kind of interesting. I mean, you probably get this just mix of ideas and like personalities and stuff that kind of drive some like magic moments, right? I'm sure you get just like these serendipitous things that happen throughout the day that you just can't manufacture that stuff, which is I think really cool to hear based on what you do.
I think what we realized was the founders at this stage, they're looking for a few things. And capital is only one of many, because the capital, you don't really need that much capital, especially with AI these days, to get off the ground. So yes, we provide the capital, but that's a small part of, frankly, the value prop. The other thing they're looking for is a community, right? Is to be around like-minded people who are also building, who are also kind of going through these gyrations of what 0 to 1 or negative 1 to 0, whatever it looks like. And especially if you're a student, like, you're so used to having a community around you in your dorm that the idea of going out and starting a company is kind of daunting and isolating. So if we can provide that community still, I think that's pretty powerful. And then, of course, they're looking, for us to help them kind of, given the vantage point we have of having worked with so many companies over so many years, being able to help them kind of see stuff in their blind spot. So, that's how we've kind of designed the program, is to not just be about capital, but much more than that, and community being a big part of it, as you mentioned.
Yeah, that actually maybe leads to another topic, and maybe we can start this question. Just if you can give the audience a little bit of color on what are you guys looking for? What's the right sort of deal profile? Who are the founders that should come to you? And the second part of the question is, as you talk about the differentiating factors, and you mentioned Sequoia, now there's, the South Park Commons, there's obviously all the accelerators that are out there. The landscape of pre-seed has changed really dramatically, especially in this AI world, and especially in the last couple of years. And curious kind of how you guys think about standing out, or what's your kind of secret sauce to making sure you still get the best founders to show up to Afore?
Yeah, you think about it at the top of the funnel, which is where we sit. There's obviously a lot of companies, a lot of founders, right? And arguably that number is increasing rapidly thanks to AI, which I think net is good. Obviously, not everybody should be an entrepreneur, because building a company is very hard. But I think more people will take a shot on goal, which I think is great for society, is great for them, and the barriers to entry are only lowering, which all is good. So at the top of the funnel, frankly, there's a lot of surface area to cover. And honestly, our biggest competition is ourselves, which is a deal that we should have seen that we didn't, right? And because we didn't have the right networks, or we weren't at the right place, right time, we weren't top of mind. Those are problems we're trying to solve. Rarely do we go head to head with anybody else for a whole host of reasons. Part of it is because we do invest very, very early, but part of it is there's just so much surface area to cover, and frankly, not that many people practicing the way we do. I think to your question on what do we look for, obviously, we invest very early, so a lot of it tends to be about the team, right? I'd say 80-90% of our diligence process is so much just trying to understand, is this the right team to back? Within the team, what do we look for? I'd say three things. Number one tends to be around the growth mindset, the iterative mindset that this team has, right? Is this a team that's very linear, or is this a team where in 5 or 10 years, their slope of the curve will look like this, right? And I think that's what we try to figure out. The second is speed. I think pace matters a lot, right? I think they have to be able to ship fast, move fast, especially in this crazy AI world. And the third is grit, right? Are they in this for the long run? Are they in this for the right reasons? building a business inevitably is going to take a long time, 10 plus years. And it's going to be lots of ups and downs. And I think can this team kind of navigate through all of those three? And so I think we try to like triangulate, I see those three things based on just spending time with them, doing a lot of back channel and so on and so forth. And frankly, spend less time on like the exact idea and market and TAM and so on and so forth. I think those things start to matter later stage, but there's so much of it is unclear. And I'd say we haven't done the math, but like vast majority of our companies are probably pivoting, right? Post our investment, right? Some completely changing the market, some changing the product, so on and so forth. So I think we have to be very open-minded on kind of which direction this team may eventually go. The good news is that we feel like with AI, there's opportunities everywhere in every industry. Historically, one or two industries used to have tailwinds. Right now, every company on the planet is wondering what their AI strategy is and what products they should be adopting. So like that's a great time to be an entrepreneur where like every company is a potential customer of yours. So I think for us, it just really comes down to the team.
And I think maybe interesting time to talk about team selection. And again, I think for purpose of our podcast, we really want to make sure that we give these founders at your stage the right ammo to make sure that they come talk to the right people and they're ready to pitch when they come talk to folks like you. So I think you have this 10,000 coffee rule you talk about. I think for the audience would be helpful to just describe what the 10,000 coffee rule is. And I think the second question is, given that you invest so early and the dynamics that you talked about around people pivoting and things like that, and we all know this in venture, it's like people are the most important thing. Like, what are the things that have shaped your judgment? Like, what are the things that kind of make the flags go off in your head when you talk to a great founder and a founder that's a right fit for Afore?
Yeah, so much of trying to read people is subjective, right? Especially when you're trying to predict on how people will change and evolve. It's very subjective. And what that means is, A, obviously we get it wrong a lot. And B, what it also means that it's the only way to really get better at it is just to put more hours, right? I mean, the 10,000 coffee is somewhat, borrowed from 10,000 hour, Malcolm Gladwell book that if folks haven't, I strongly recommend. But, I've been doing the same business for 14 years now, right? I was trying to calculate, I probably looked at like tens of thousands of pitch decks at this point, right? To invest in a few hundred companies that I've been involved with. So you just like imagine being a batter. You're just standing at the whatever the mound or the pitch, and you're just like looking at pitch after pitch after pitch for like 14 years. You're just like so clocked into this point, and having now seen the full life cycle as well of companies I invested in and that became worth billions of dollars and exited and so on and so forth, and a bunch of them went to zero, and you kind of learn from all of those loops. So much of this business is just about pattern matching and learning from the past. But a lot of it is also like being open-minded. I mean, this is really a business of exceptions, right? And the alpha is all on the edges, and not letting your past kind of be baggage. So I think balancing those two things it's not easy. I think you don't want to be too open-minded either, because there's a lot to learn from past in terms of what kind of people make great entrepreneurs and what it takes to build a great company. But at the same time, the rules are changing and arguably changing pretty fast with AI. So anyway, I do think having that experience, just doing the same thing over. I mean, this is why we focus a lot, frankly, on our stage. And while there's been temptation to go multi-stage, right, as you are a little bit more successful, we just think like that focus really is how we're going to be differentiated, right? When other folks are doing this as more of a call option to say, like we should also throw some money in interesting founders and see which ones take off, and then really, pull up the truck at Series A. We think if this is all we do, I think we can source better, pick better, and then support the founders better, and that eventually should lead to a much better product for our customers that are the founders.
And maybe just to clarify, like as founders come talk to you and pitch you, like what are the things and signals, like when do the flags go off in your head when you're hearing someone pitch you?
Yeah, a lot of it is about the micro, not the macro. I think the founders that are very top down on like, I read this McKinsey study that said XYZ and this market's going to be big, and like, it's less interesting, to be honest. I think what's more interesting is like, hey, I found this like small niche audience or customer base that really cares about this thing, and I'm going to start like, this is the wedge product. And like for this customer, this problem is like a 10x, or it's a hair on fire problem, and things will fly off the shelves. I think that's what I'm looking to really understand: the short term, the micro, what's happening on the ground, and the founders who can really go into a lot of detail and get me excited that this. I may not know much about the industry or the customer, but as they're explaining to me, I'm like, oh, this sounds like a really acute pain point. Like I can see why, like if this is true, your customers are going to really care about it, and then I can kind of go back channel that or validate that through my own work. But at least I should walk away feeling like, man, if this person is right, this is gonna work in the short term. And then I have to figure out if you're the kind of founder who's gonna go from strength to strength, right? I have to figure out that you're the founder who's gonna figure out how to get to first base, and then you'll kind of survey the market and figure out your plan from how to get to second base. I don't think I can predict that right now. I don't think the founder can predict that right now, but at least I believe this is the kind of person who has that ability to figure it out. So that's sort of how we think about it. Yeah.
Gaurav, to reaffirm your point, I think one of the common mistakes we see founders make is always like, TAM is important, but, hey, I'm capturing 1% of a $15 billion market rather than this methodical, like, how do you build a large company from the ground up and what are all the steps you need to get there and why are you the right person to do that? So, I think we align with a lot of that and, kind of see both sides of the story on the founder profiles. Going back to founder profile, you alluded to this a little bit with this AI wave. Founders are younger, less experienced, more AI native. You've called this more of a feature, not a bug. It is interesting to see how this will play out longer in the cycle. But, what is this teaching you about sort of like limits of like the no bias thesis? Are you guys more open-minded right now? Are you gravitating more towards that type of founder profile? Would love to hear your thoughts.
Yeah, I mean, look, the younger founders obviously have an unfair advantage because they're not they're not jaded and they're not sort of bogged down by like what was possible and not possible before. They're AI native. The AI is like as natural to as like the internet was to me, right? Growing up, like I don't know the pre-internet world, right? I know the pre-AI world, so I know what was possible, what's not. But the younger founders obviously are AI native, and that's a huge advantage for them. But ultimately we still look at it from a first principles perspective, right? Is like, are these founders have those sort of the three qualities that I talked about before? And look, I'd say a lot of them are obviously on the younger side, but we're also still funding founders that are older than that that have more work experience, and that's fine. Like I don't think entrepreneurship has like an age limit to it. I think we have founders who well into their 40s and 50s that start companies and have built great companies in our portfolio. So I think we're not I think age has correlation, certainly not causation. And again, we really try to figure out if these founders, if these people can build a big company and move fast and then given most of the investments are AI companies, like do they really truly understand how AI can be a superpower, right? Are they like superimposing or just dropping AI on top of like just a generic idea, or this idea would only be possible because of AI? I think that's more interesting to us, and I think that starts to show us how well this founder has internalized AI. I'd say that's probably more important than anything else.
I think there's another interesting topic here, which is around what's obvious, what's not obvious in AI. I guess maybe to high level summarize it. I guess the question is, look, I think everybody knows there's this like archetype of AI founder that everybody's chasing, the researcher and kind of folks like that, or came from an AI native company. I mean, you guys are backing some of the earliest companies. You guys are taking interesting bets. I mean, you yourself said like try to avoid the bias. Like, what's a theme or a thesis or a take on the market? Like, what's not obvious in AI just yet? Like, are there things that you're seeing at the ground up that are not obvious to the broader market that you're excited about?
Yeah, one, maybe it's a hot take or maybe it's not, but like I know people poo-poo the app layer a lot on like, and maybe some for good reasons. Obviously, there's a risk of a lot of competition as barriers to entry go down, and there may be a lot of app layer companies. There's obviously the risk of getting cloudified, as the foundational models build first-party apps. There's maybe a risk of incumbents, building some of your tooling. But I actually think like most of the value will accrue eventually to the app layer, right? And I actually would worry more about the foundational model layer than I worry about the app layer. And here's my thinking around it. I think right now the Anthropics and OpenAI of the world have an intelligence advantage, right? They're 6 months, maybe a year ahead of open source, of other competitive models. So, our app layer companies gravitate to them, and some of them are spending millions of dollars a month on Anthropic and OpenAI. And hence these companies are growing very rapidly. But I do think like open source and other competitive models will catch up to a point where they may not be at the same place as the state of the art, Anthropic, OpenAI models, but they'll get to be a place where they're good enough, And at that point, I think what will matter most are the companies that have customer context, that are truly solving customer problems. And I think the bar for the customer will just go higher and higher. I think just applying Claude to your workflow will not be good enough. I think your expectations will go up. So I think that's where you'll need a more targeted, focused software for yourself. I mean, it's sort of this, we were talking about venture capital, right? When venture capital was invented, like the same investors would do everything from seed to IPO. But as there was more competition, we had to kind of segment the stage, and like we focus on one stage and don't do the other stage because I'd love to do all the stages, but I feel like it's so competitive that I have to just focus so I can be really good at one thing. I think same thing is going to happen, on the app layer, but the markets will be so large, and especially with labor replacement, I think these opportunities are so big that the area under the curve, I think will still be very much in the app layer, not too dissimilar to the cloud, what we saw with the cloud. I think a lot of folks would probably disagree right now. They would say the model layer and maybe the chips layer, and that's where all the value will accrue, and the app layer is going to be commoditized, TBD, but I'm pretty bullish on the app layer.
Yeah, I the thing is, I spend a lot of time on the app layer as well, so I think I'm also bullish on the app layer. I think we were actually having this conversation on a walk, I think, last year, and I'm curious kind of what's changed in the, I guess probably been about a year actually since then. This notion of seedstrapping, especially at the app layer, I think is actually quite interesting. I think for everybody that's listening, might be good to talk about what seedstrapping is. And then B, I think the other question is, how has this notion of seedstrapping then impacted the outcomes that you're seeing across the portfolio, and kind of what outcomes are now possible, especially given that you're bullish on the app layer?
Yeah. The idea of seedstrapping at a high level is basically that you raise like one round of funding, right? A seed round of funding or pre-seed, and you can essentially just build a company from there, and you're cash flow positive and never have to raise capital again. A version of bootstrapping, right? Bootstrapping would be you never raise any capital, you put some of your own money, and then you never raise capital. Seedstrapping would be you raise one round of funding because you need some capital to get into business, right? To run a bunch of experiments to see what works, and then once you get there, then it just sort of takes off. First of all, I think AI will definitely enable that. I guess where I've probably changed my mind a little bit in the last year is I think a year ago I might have been like, oh yeah, companies might never raise money again because they'll just be cash flow positive, they'll be growing, and they'll be great. I think what we are seeing is a little bit different, which is companies raise, let's say, anywhere from $500,000 to $2 million to get started, and maybe they might raise another little bit of capital after that. But once it starts to work, they still raise money, they can just delay the next round for far longer than they would have before. Like before, the companies used to be on this treadmill of every 18 months you got to raise. I think once you get to product market fit and like some early traction, we're finding that the companies don't have to be on a treadmill per se. But what we are finding is companies are still raising capital, a lot of capital, just later at a higher price because it's still expensive to like become the market leader. It's still, especially in B2B enterprise sales, where you got to build this enterprise sales motion, it's still expensive. It's still like a J curve you go through where you burn a bunch of capital as you put up that, as you light up that sales motion. And frankly, you're probably investing a lot in R&D to accelerate product development because it's starting to get competitive. So I think for that category leadership, we're finding companies are still looking to raise capital, but there's just a bit of a gap in the middle, which I think is good for founders because the dilution curve starts to look different, right? Where if you're raising every 18 months, you're getting diluted by 20% each round. and founders may end up with like half or less than half of where they started. Now you may actually get diluted much less. And it's also great for seed investor, pre-seed investors where, less dilution is better for us as well. So I think that's sort of maybe what we are seeing, a version of seed strapping, if you may. And ultimately what it comes down to is capital efficiency and more operating leverage, right? The idea being, like historically 70 cents of every dollar that we as investors would give founders, it would go towards engineers, right? Like that was the biggest line item. They're obviously not buying machines. They're not opening factories. They're just hiring a bunch of engineers, right? But now if one engineer can do the job of 10 or 15 or 20, you produce more code, but it's also cheaper to be able to get to market and be able to launch new features and solve customer problems. So I think that's sort of what you're starting to see percolate through until you need big enterprise sales motion or spend a bunch of money on brand marketing. All those things are still expensive, right? Catching attention, right, of customers one way or the other. That stuff hasn't changed, and for that, you'll need to raise capital.
One good transition with this. So you talk about how you can be more efficient on the capital side. Companies are also getting to scale quicker. I know you look at stuff inception stage or even pre-inception, but for the deals you're evaluating where it's sort of a pre-seed, they've had a few months to go at this. They already come to you with like 300K ARR. We're seeing a lot more of that stuff. So how are you evaluating that for net new investing? And then, as your companies are going to raise seed and A, the benchmarks, the bar has been set even higher. It's like 3X would have been like an automatic, like, hey, we should really think about this deal. And now it's, 5, 10X. I don't know if that is a fair expectation for founders. I think everyone's kind of, FOMO on some of that stuff, but would love to hear your thoughts on both dynamics when you're evaluating net new deals and, advising your companies at seed A and beyond on what they should expect.
Typically companies that we're investing in don't really have much traction or frankly even a product in market. In fact, the bar we set for ourselves is that the founders shouldn't even be running a process when we intersect with them, and we should be getting to them well before that. So I'm not sure like how much of the diligence from a traction perspective has changed. Again, it's really just about, I guess the one thing that has changed maybe because we're investing so early and earlier as we go is trying to really figure out if this founder has it's less about like, is this a good idea? It's more about like, can the founder find a good idea? Or when they see a good idea, will they know it's a good idea? Or will they settle for like a mediocre idea, right? I think the worst thing that can happen to a good founder is ending up with a mediocre idea. And like 5 years later, you realize a mediocre idea. And it's like, now we wasted a bunch of money, more importantly, a bunch of time. And so I think we want to really have a high bar on that. But to your point on the portfolio of raising follow-on capital, I think we've definitely seen a major shift on, what it takes to be able to raise the next round of capital. I'd say the more than the actual absolute revenue number, it's the growth rates. The bar on that is pretty high because there are a lot of companies growing very fast, and as a founder, I can see why it's so frustrating because you're like, my business is doing so well. How is this not good enough? And then I have to kind of explain to them, look, as an investor, look at it from an investor's perspective. Like, I only get a few bullets a year, and I got to prioritize. So like, I'm not saying you're bad. All I'm saying is like, for better or for worse, I have better options, so ultimately VCs are going to pick what they consider to be the best amongst what they have access to. And if your growth rate is good, but not as good as what something else they're looking at, well, that's that. But I'd say even more than growth rate, what we are seeing a shift, I'd say in the last few months, maybe last year, it's just the kind of companies VCs are willing to back. I think what was maybe okay like a year ago where you were simply a wrapper, on ChatGPT and you were getting a lot of traction growing like crazy. Maybe you could have, with a strong founder or a good storyteller, you could have raised around. I think those companies are having a harder time. I think there's definitely more scrutiny around, well, what's the durability here? Where are the network effects? What's the, let's assume the models just keep getting better, or how does this not just, built in-house, or will the incumbents, do it? So I think those things are getting more scrutinized, I'd say. Which I think net is good because obviously, the later you go, the fewer, later stage investor you are, the fewer bullets you get a year to deploy. So you really want to make sure these companies can go all the way, especially if you're paying a high price. These AI deals are not cheap. So I think you've really got to believe the outcome is commensurately that much bigger. So I'd say that is probably what's changed from a follow-on perspective.
I guess maybe couple things in here. One, curious kind of how you advise your companies then on exits, and I mean, even in the seed strapping world, does that mean the way investors get paid out is different? So like, how are you advising your founders on exits? And then I think the related question to that is, where do you even fish? Because obviously there is definitely a certain profile that's like exciting in the valley now, especially among the large multi-stage funds. You, for example, I mean, coming from Canada, you've done a lot of stuff out of Canada. Like, is there an arbitrage opportunity there? So, like, I'm curious. A, like, how are you thinking about distributions, and how do you think about the exits for some of these companies? And then B, how does that change the places where you can fish?
Yeah. Exits are obviously really hard to predict, certainly at our stage, but even, ever, because companies are bought, not sold, and the founders don't really control who wants to buy them or when. But, we focus more on like, what do we control, right? And the things we control, obviously the execution of the business, right? Which is, the revenue, the growth and all that kind of stuff, the margins, but also just like how much capital do we raise, right? And what kind of path we're on. I do think being more capital efficient gives you more optionality on exits. We had a company that was called Goldcast that was acquired last year for just shy of $300 million. I think if that company had raised the last round at $1 billion or even $500 million, right? Like 300 million wouldn't feel like a huge success, right? Or if God forbid, their pref stack was like $200 million, right? Like 300 million wouldn't be very good. But because they were always capital efficient, they didn't really raise that much money. We invested in that company at like 5 million post money or something. Like, we did great, right? We had an amazing return like good 35% of the fund, amazing net IRR, like 72% or something. It was a really good outcome for us. And I think for other investors on the cap table as well, even the ones that came later than us, because the founders were always very thoughtful around how much to raise at what price. And it was also a great outcome for the founders, right? So look, we're not in the business necessarily for $300 million outcomes. I love $3 billion outcomes or 30 billion, but I think capital efficiency is just gives you more optionality, right? And if business is working well and your growth rates are high and the TAM is large, keep going. You don't have to sell, right? I think in this case, the Goldcast founders felt that this was the right time to cash in the chips and join somebody else versus keep going and raise more capital, which I think was the right call in retrospect. So I think it's great for founders. It's great for early investors from an exits perspective. And then on the question on where to fish, honestly, I don't know if there's like a silver bullet. I think there's amazing technical talent that could be great entrepreneurs everywhere. I do think like right now there are two types of founders, either ones that are already in SF and the second ones that are on the way to SF, for better or for worse. They've definitely seen a shift in just like where people want to build, which I understand. I think talent density matters a lot because a lot of the, what you learn about what's possible and not possible is like from hanging out with people around you, your roommates, living in a hacker house, so on and so forth. And a lot of those builders are here in this kind of super cycle. So we definitely, and look, I grew up in Canada, so I've got a network. I've invested everywhere from Vancouver to Halifax at this point in dozen plus companies. So I definitely, see founders through that network, into University of Waterloo, which is a great, source of technical talent. So we see stuff there, but I'd say that's still a relatively small portion of kind of where we get our deal flow. We get deal flow from, a lot of the technical schools in the US. Our portfolio founders send us, folks because people ask them, like, who do you recommend to have on your cap table as a first investor? So I'd say it's a little bit all over the place. And of course, folks spinning out of companies, right? That was always our thesis around Afore when we started was like, Apurva came out of Amazon to start Instacart, or Ben Silberman came out of Google to start Pinterest, and you can just go on and on and on. Where people, these folks that are entrepreneurial, usually a lot of product managers or like product-oriented folks kind of see, like this doesn't fit the roadmap for the mothership, but this could be a business in and of itself. Let me go, branch off and start something. And like, so we've got kind of nodes inside of these companies. So it's like all over the place, I'd say. I think maybe there is some arbitrage is like helping non-SF founders move here. I think this is why we have like, 20 odd founders work out of our office at any point in time is like, hey, look, we can like help you. We can be the launch, the landing pad for you, right? As you kind of, move to SF and build a network here, we can help you with that journey. But I'd say there's talent kind of everywhere.
Let's go back to the outcome expectations because it's a really important distinction, I think, for pre-seed founders or folks looking for pre-seed funding. How do you what should founders know? Because obviously your math, is $180 million fund is going to be way different than a 3, 5, $10 billion fund. So what should founders know as they're looking to find the right pre-seed partner with optionality, with the time that folks would spend, and definitely not to disparage the multi-stage funds. I think there's a lot of pros to that, but how would you walk someone through what are some of the talking points that you say when you're looking to win deals against some of the larger funds at inception stage?
Yeah, I mean, what we tell founders is look, prioritize folks that'll prioritize you. And in this business of venture, I've come to realize the biggest constraint is actually your time, not the dollars. You can always raise more dollars, but no matter how hard you work, you still have 24 hours in a day. And it's still a high contact sport. I think the reason founders, pick their investor versus just taking the best terms is because they want to work with people they feel like could be helpful, that they understand their vision, so on and so forth. And if you're at a massive platform, big fund, writing a small check, it possibly cannot be a good use of your time, right? So what that means is you're not going to spend much time, which is the right thing to do, right? Our LPs remind us, spend time where your dollars are. And hence, if you take money from a big fund, just know full well that it's a call option for them. They might give you better terms because, again, the cost of capital is low for them because it's a call option, but you're not going to get much support from them. But if you break out, then they'll suddenly be interested in you because they want to then graduate you to their core fund. But until then, you're basically a sideshow, which we find certainly the second time founders fully understand and internalize that. The first time founders sometimes can get caught up in the cachet of the sandhill firms that have household names. But I think when they talk to some founders who've been through the journey, who've had multiple options, I think they pretty quickly understand the pros and cons. And ultimately, look, it's you're not even picking the fund as much as you're picking the partner inside the fund. So I think we look to really build those connections with founders and that trust that, we want to be your consigliere as you get to product market fit, to be able to win those deals. And also it is a matter of when you intersect with them, right? Are you able to see these deals early enough such that it's not a competitive process per se? And a lot of times founders, they don't want to run a process that's protracted over months. They're looking for not a lot of capital, fair terms, and somebody they like and they feel like it can be helpful, and then they're done and they get back to building. And I think our job is to be able to make that case to the founders.
So, and you make a good point. One of our principles at the firm is we strive to be that first or second call or tax you'd make along the syndicate. But you have multiple funds, the portfolio gets bigger and is cumulative. How do you manage it as you scale? Now that you're a $185 million fund, how do you kind of keep that concierge? You can pick up the phone. I want to call Gaurav. He's my most trusted investor. What do you guys do as GPs, and what's some of the infrastructure you've built, and how do you kind of manage this as you continue to scale, do more investments?
Yeah, I mean, look, load balancing is very important, obviously, because we still only have 24 hours in a day. Our SLA to founders is that we will be the most active investor you'll ever have on the cap table between us and the next round. So we're going to be super hands-on, talking to you all the time in Slack, texts, in person, Zoom, once a week, twice a week, every other week, whatever it is. But once you raise the next round of funding, whether that's a seed or Series A, then you form a proper board. You've got somebody else as kind of the first line of defense. You can still call us. Sometimes we get calls the night before the board meeting to be like, hey, can we talk through the board meeting tomorrow? Here's how do I position this and that? Or hey, I have this issue. I want to talk to my board about it. I wanted to pass it by you first. I trust you. What do you think before I go to the board? So that's cool. I'm on speed dial. That's awesome. Call me. But I'm not I'm not the first person you should be calling for everything. And that just allows us to really focus on a small set of deals, right, at any point in time. And then we get involved in the later stage stuff more strategically. We're still involved in some of our companies, like with High Touch, they just raised a Series D. We're very involved, right, in making introductions to investors and helping think through like the different options and bringing some LPs into the deal. And so all kinds of ways we get involved. But it's sporadic. It's not as frequent. And again, that all comes down to focus, right? Again, we tell founders like that's the product you should expect from us, right? Versus if you raise from a big platform, their focus is somewhere else, as it should be. So you're not going to get that time and help, and not to mention the signaling issues that may come through, or conflict of interest if they're also considering leading your next round, but they're also giving you advice on how to run a competitive process. Like all goes to those things that are not an issue for us. We've also expanded the team. We've got 7 investors now on the team, so we can cover a lot more ground, and each one of us is full stack, so we're all supporting different founders, which helps a lot. We've also obviously used AI and built a bunch of software to be able to, whether that's a product called Hive that we have for go-to-market and customer intros, where we've tens of thousands of connections through different networks that we built, where founders can go in and search for like, I want to get in front of this customer or this person, and we can help you get in front of them. So there's a bunch of tooling we built to help founders with customer development, fundraising, and recruiting. So it's a whole bunch of different things, but a lot of it I think just boils down to focus.
Yeah. It would be cool. Like this goes back to like musings. As we're talking about the portfolio, what are some of your favorite stories over the years? Like obviously you're in companies like High Touch and Modern Health and BenchSci, and you've obviously built like an awesome portfolio. So what stands out? Like we were having a couple conversations on some of the earlier episodes on being at a restaurant and hearing the pitch for the first time and meeting the founder and just eureka moment. So we'd love to hear what stands out, not to put you on the spot.
Yeah, man, there's so many. But I'd say the one through line I feel like is the most satisfying part of the job is just seeing how much the founders kind of evolve and grow, and the people they become, and the businesses they build, and where when you back them, right? I mean, I think of like the Gamma founders, for example, when Grant pitched me initially, he was in London. He was like it was peak COVID. It was like 2020. He was like in his kitchen. He was like late at night. It's really dark. You couldn't really see him that well. The kids in the background. He's just like that. And like now he's running like a $2 billion plus company. I go to the office now. It's like this beautiful office, and like all it's just they're like massive TV screens. I don't know, probably 100-person office. It's just it's so cool to see that. It's a little bit like now I've got young kids and sort of see kids grow up. Or High Touch, where we invested when it was just one founder, right, on working on a different idea, working in travel, and believing in him, and he managed to attract a couple more amazing founders, pivoted through many things, and like also seeing these companies go through ups and downs. I think you realize it's a long journey, right, and you can't sometimes you look at the stock market and you're like the daily movements, and you then look at your portfolio in the fund and you kind of expect similar movements, but you just realize it's a very different time scale in venture. Like this company High Touch, they went through a bunch of pivots because they were working on travel in COVID. Turns out travel was not a good category during COVID, so they had to pivot and went through a whole bunch of different ideas. And honestly, if you'd asked me circa 2020, not that long ago, like will High Touch be one of your breakouts? And I'd be like, I don't know, it could go to zero. They don't have a good idea yet, and then seeing where the company is today, it's just closing around at 2.75 billion, just crossed 100 million revenue, like absolutely crushing it, attracting amazing people. So I'd say like those are probably, when you like look at those stories, it sort of just makes the job worth it, because man, like otherwise like every day there's like companies or shit's going hitting the fan, and like I'm trying to deal with fighting fires and like trying to fundraise for our fund at the same time, and it's just like there's a lot of moving parts. But when you look back, Goldcast, I think that's probably a good one, where I just did a podcast with the founders. They put it on LinkedIn, but the founders talk about how apparently we were like the last people they were going to pitch, because like they had already heard like 70 no's or something, and if we had said no, they were going to go back to school. So they were in business school at the time, between first and second year, and I wanted to start this company Goldcast, but if they heard, all no's, they were forced to go back to school because they were on F1 visa. They were on a student visa. So they couldn't just drop out of school until they have funding to get the O1 visa. And, nobody was giving them funding because they were still in school. And, the idea was considered at the time not that interesting. And, I'm glad we decided to back them and lead that round. And, they built a business that, was just sold for less than just under $300 million in cash. Like, that's cool. Like I was like, wow, like I had a small impact in their journey, in their life. And hopefully they're going to go on to do even more wonderful things. Anyway, just when you hear things like that, and one of the interesting things with Goldcast, I was asking the founders actually this. It's like, you just made a crap ton of money. Like, what is that? What's been your as you look back on the Goldcast journey? And the first things one of the founders said was like, a bunch of employees called me and said, oh, we just paid off our student debt, because of this acquisition. And like, I was like, wow, like indirectly I had an impact in making that happen. So anyway, those things just make it all the worthwhile.
Super cool. I mean, I think those are always the fun stories for all of us as especially at the early stage, right? It's like you see these things before they become like the machines they are at scale, and it's just like super fun to watch that journey and that growth over the years. And I think it's like funny. There's obviously a lot of misses just being as part of a early stage investor. Like you're just naturally gonna have a lot of those, but yeah, yeah, exactly. But like, I think you just know that like at the end of you have to enjoy the process, and I think you have to be able to appreciate the other side of it when you see these companies kind of get to something really meaningful and building cool companies. I think maybe coming back to some of the tactical piece of investing at this stage, Gaurav, I have a question for you on how you're advising your founders or folks that come looking for money at the pre-seed. One of the challenges that we're seeing, especially seed and A, or even pre-seed now, like the expectation is that you got to raise a lot of money to have like the halo and the momentum and like all the stuff, so that like next round fundraising becomes easy, hiring becomes easy, blah, blah. Like call it like maybe king making a little bit to some degree, but also just like the signaling around the market. Funds like us, funds like you, were not set up to do that sort of deal. And I'm not saying that's even required to actually go build a great company. In fact, I'm not even sure giving more money to a really early stage company actually drives better outcomes. I'm curious, A, your observations on the market, and then B, how do you combat that narrative when you have founders that come to you?
Yeah, I do think capital can be a weapon, but if used at the right time. So I did this part of the podcast with the Goldcast. We talked about king making actually, because when Goldcast started, there were already 2 or 3 companies that had been funded by Andreessen and Excel. The most notable one being Hopin. Right? I think their valuation at peak was like $7 billion. It raised $1 billion in total venture capital, and it was like a direct competitor to Goldcast. So they were always like the sort of David versus Goliath, like always in the shadows of some of these bigger companies that raised a shit ton of capital from top tier funds. Turns out most, if not all of them, went to zero, and Goldcast was the only last one standing and had a good outcome for everybody involved. And, in retrospect, I think what went wrong is those companies raised too much money too early, before they had truly found product market fit. And what ended up happening was they went in the wrong direction really fast, which turns out when you do that, you end up even farther away from where you want to go, right? Versus if you are moving slower, you can even if it's in the wrong direction, you can kind of course correct and get on the right track, which I think Goldcast was able to do mostly because they couldn't raise a lot of capital because they were always in the shadows of these companies. So they always stayed focused on their niche and didn't try to, work on too many different initiatives and hire too many expensive people. But at the same time, I think once you've found product market fit, you feel like, this is working. You've found the right customer. You're delivering amazing value for the customer, and things are going well. I think at that point, using capital as a weapon could work, because then you can put the capital to work, I think, in a much better way, but also it sort of discourages more competition getting funded. And I think in a world where competition will be a bigger problem for companies than historically has been, mostly because the barriers to entry are going lower and more people are starting stuff. I do think that's valuable, right? But I think used too early, I think it can do more harm than good. So we actually discourage founders, frankly, from raising too much capital too soon. Sometimes this conversation does come up. It'd be like, oh, if we could just do this, we'll lock up the category. And I think folks talk about this, right? Companies die of kind of what is suicide more than homicide, and I just like or like indigestion more than starvation, right? It's just like I just don't want you to end up in that place where, and look, founders are like, no, trust me, I'm just going to put the money in the bank. I'm not going to like do XYZ. Like, Anamitra talks about this. He's like, it was a universal law of burn. No matter how much you raise, you have 18 months of runway. And if you just raise 10x more than you needed, that means you're burning it 10x faster. And I don't think that's healthy for companies early on.
Yeah, and I think the other challenge and question, especially look to your point around like once you have product market fit, then it's all about owning market share and kind of getting like. I also wonder, and I'm curious, kind of what your thoughts are on this, since you talk about speed as a moat. Like what like defines product market fit in this day and age as well, right? Because like these companies are getting to revenue way faster. And I'm not saying this is true across the board, but like we don't know what's durable, what's not durable, and so like. I guess as you coach your founders, like how do you avoid them falling into this trap of like kind of fake product market fit and running 100 miles an hour in the wrong direction? Like what are the signals you're telling them to watch out for?
Yeah, there's obviously a lot of blog posts written on terms of quantitative ways of kind of measuring NPS and things like that. But I'd say like qualitatively, when I get the sense that the founders are pushing a boulder downhill versus uphill, I feel like that's product market fit. And obviously that's, again, very, very subjective. But you sort of see in like subsequent meetings that like things are getting easier in some ways for founders and they're solving better problems, more high leverage problems, bigger problems. That's when you feel like, okay, clearly the market is pulling them in, right? Clearly they're not having to push a boulder uphill where it's like, yeah, we're trying really hard to close the deals, but they're not closing. Or like, yeah, customer acquisition is very expensive. It's very hard. And we don't know where the next customer is going to come from. That's pushing uphill, which is fine. Early days, that's what it's like. But at some point, it's got this. The slope has to go from uphill to downhill, and you start to see that in just like revenue growth quarter after quarter in terms of growth rates going up. Customer acquisition costs coming down, maybe NRR going up. Like you start to see some of those signs. I don't want to like talk about something very, objective because again, there's so much, written about it online that people can read about. But at least that's when I get the sense that like, okay, you know what, this fire seems to be coming together. Let's put more fuel now. Right. And then look, it's again, subjective call. We could be wrong. Maybe we're not quite there yet. Maybe we'll fall out of product market fit in 3 months, maybe whatever. A lot of shit can go wrong. But I think that's when we tell the founders to kind of trigger a process and raise capital and accelerate what's working.
So going back to musings, last 10 years, would love to hear some of the lessons you've learned, Gaurav and Anamitra. Like, what would you tell both of yourselves in 2016? I think we have some emerging managers that listen to the podcast too, and helpful for some of the founders here to hear as well. How you guys have kind of iterated over the years.
Yeah, one of the things as I look back, that has changed. Some of that's changed my mind, but also just has the challenges have changed over time. When we started the fund, the hardest thing was fundraising, then investing, and then team building. I'd say today it's kind of flipped. Fundraising is not easy, but thankfully it's gotten much easier, given we have a track record and so on and so forth. Investing is, I guess, finding and picking great companies is still at the same level of hardness, I guess. But building a great team, building a world-class team, that's probably the hardest thing, the challenge that we solve for. And there's a few reasons for that. I'd say I hope our bar is pretty high because we're looking for folks with a lot of agency, right? We're looking for full stack investors, regardless of your title. We want people to be able to source, independently be able to do work on it, search for the truth, be able to advocate for those companies, be able to support those founders, be able to win those deals. Like we want everybody on the team to do that. And part of it is because, again, we invest so early, so much is subjective. It's hard to like discuss and make a consensus-based decision on like what you felt when you talked to that founder. I think somebody whoever's closest to the coalface has to be able to put their neck on the line and say like, look, the resume may not look very good, but trust me, like this is going to be the next big thing, and like here's all the work I've done. So I think finding those people. And then of course, training and mentoring and helping them become great investors. Like that's probably where I spend a lot of my time. And look, a lot of the folks that we would love to have at Afore have historically like raised their own funds. I think raising a first-time fund has gotten significantly harder over the years. So, as much as I obviously support people starting funds, and we did one, and I'm investing in funds, I'm helping folks starting new funds. Our hope is some of those folks will come join Afore as well, because we think we have a great platform to help them, do what they do best, which is investing and not having to deal with all the other stuff around running a fund. But I'd say that's probably, I think over time you realize one of the hardest parts about, I guess, building any business, but certainly the venture business.
Yeah, and we tell our founders the same thing, right? It's like you as a great CEO, you're spending maybe a third, maybe even probably even more than that of your time hiring and looking for the best people. And so I think we should, as investors and builders of our own platforms, take that message to heart. I know we're over an hour here, Gaurav, and so maybe on a closing note here, love to hear your takes on what is the future of the pre-seed category, your hot takes on the market.
Yeah, what's interesting is AI has made, I think, pre-seed even more compelling, because founders can get done a lot with less, right? And pre-seed was all about raise less, not more, dilute less, not more, right? Get started with less, not more. And I think with pre-seed now that's kind of on steroids, right? And we have noticed in our portfolio that founders are getting to $1 million ARR, and kind of a loose proxy for product market fit, twice as fast and by burning 1/5 the capital as pre-AI companies. So clearly things are shifting. But, we still think founders need some capital, right, to be able to quit their job, go full-time on this, support themselves, maybe if their family, pay for whatever, OpenAI, Anthropic credits, whatever the things, different things, the cost of running a business, go to conferences, so on and so forth. So, we think that number maybe changes over time. Obviously, 30 years ago, pre-seed was like a $10 million round because you need to get data centers and buy expensive computers and shrink wrap software. Then it became like $1 million, $2 million bucks, with thanks to AWS and the cloud and Stripe and everything else. And I think that number has probably come down even further to like maybe $500,000 to $1 million now. I don't know if there's a floor to that. Probably, is probably kind of where it's going to be for the foreseeable future, given the hard cost of like just supporting yourself and your team. But I think that's kind of, we think, but that's one thread. And the other thread is like, as the barriers to entries go lower, there'll be many more people starting companies. And I think in some ways, what internet did to the freelance economy, where many more people became freelancers, I think the AI can do that for the founder economy, where like many more people who might not have been founders before, or may have been founding engineers somewhere else, can now be founders and run their experiments and test the hypothesis very quickly. Which I think what that means is that there'll be many more software companies. Maybe the ultimate outcomes may be smaller because, there's more competition, but there's still like good returns if you come in early, right? Because they don't raise a lot of capital. So, I'm very bullish, obviously on this, on the category. I'm bullish on more founders starting companies, building companies. I'm bullish on innovation, bullish on AI, bullish on software. So, I think net we feel very excited. Of course, the actual tactics have to keep evolving, as the top of the conversation we were talking about, different products we've launched over time, experiments we've run, and we're going to keep doing that to be able to find the great entrepreneurs, to be able to pick the great entrepreneurs, to be able to serve those great entrepreneurs. But I think when we look at a more strategic lens, I think we feel more excited than we ever have. Let's put it that way.
Although all that being said, we did see $1 billion pre-seed round the other day, so
it also depends on what you're building, right? I think you also have to keep in mind, like if you're building a foundational model, something that's very capital intensive, maybe you need to raise a lot of capital. That's not our ICP, right? We tend to focus on very different kind of company, different kind of founder. But yeah, the term pre-seed can sometimes get bastardized. But hey, look, I'll still take that versus nobody talking about pre-seed. I think the fact that it's become part of the vernacular. I remember when we started Afore, we would tell founders we were a pre-seed fund, and you could sort of see this deer in headlights moment happen where they're like, I have no clue what you just said. They're like, I thought I was raising a seed round. What the hell is pre-seed now? I have to learn something new. And then we would go on to explain what pre-seed is. Oh, seed funds will probably tell you it's too early. They're like, oh yeah, no, totally. That's happening. Oh, it's called pre-seed now? Oh, okay, cool. Yeah, I'm raising a pre-seed round. I changed my, so like, I'm glad that cat's out of the bag and people talk about pre-seed, and maybe sometimes, not the way we intended, but hey.
A little embarrassing, but I may have asked you the same question when you guys first started Afore, so.
Yeah, well, totally get it, man. It was, but I think that's just a journey the pre-seed has been on, and that's awesome, and I think that gives us a lot of, we're very happy to see that.
Well, on that note, Gaurav, thank you so much for joining us, and I appreciate everybody for taking a listen. Thanks.
Thank you for having me. It was fun.
Thanks, Gaurav.